Right now, EXAS Sciences Corp is trading at $101.42. That is a massive surge of $15.25, marking a 17.69% gain on the day. If you are staring at your screen wondering if your data feed is broken, it is not. What you are seeing is the violent upward repricing of an asset that the market has suddenly realized was mispriced for months. But the reason for this jump goes far beyond a simple earnings beat or an analyst upgrade. The expectation coming into this week for EXAS Sciences was cautious optimism. Investors were looking for stability in their Cologuard screening numbers, and perhaps a path to sustained profitability. The reality, however, has shattered that ceiling entirely. We are not just looking at a growth company having a good day, we are looking at the unfolding of a massive corporate consolidation event that changes the entire thesis of the stock. Reports and market chatter have solidified around a potential acquisition by Abbott Laboratories, and the price action you are seeing at $101.42 is the market scrambling to price in a premium that seemingly appeared overnight. When a stock moves 17% in a single session, it usually signals that the efficient market was actually incredibly inefficient just 24 hours ago. For months, the narrative around EXAS Sciences has been about their struggle to balance massive marketing spend with the need for bottom-line cash flow. The expectation was that this would be a slow, multi-year grind where shareholders would have to be patient. The reality hitting the tape today is that a major healthcare conglomerate sees immediate unlocked value in this franchise, effectively short-circuiting that multi-year wait and delivering the value all at once. This creates a fascinating tension for anyone holding the stock. Do you sell into this massive gap up and take the guaranteed win? Or do you hold out, betting that a bidding war might erupt or that the final deal price will be even higher? This is the classic dilemma of merger arbitrage, and it is playing out in real time across every major trading desk and retail portfolio in the country. The volume today is nothing short of historic for the ticker. We are seeing tens of millions of shares change hands, which indicates a complete rotation of the shareholder base. The early morning short sellers, those who are betting against the company's ability to maintain margins, are currently trapped in a nightmare scenario. In the world of individual brokerage accounts and institutional desks alike, a 17% gap up against a short position is catastrophic. What we are likely witnessing right now is a forced liquidation of those bearish bets. They have to buy the stock to close their positions, and their buying pressure is adding fuel to the fire, keeping the price pinned above the $100 level. If you look at the order flow, it is not just small lots, it is massive block trades, suggesting that hedge funds are stepping in to play the arbitrage spread, buying the stock at $101, hoping the final deal closes at $105 or $110. This is where the modern landscape of online investing becomes incredibly important to the price action. Years ago, news like this would take time to filter through to the average investor. Today, however, traders using the Robinhood app or managing their accounts via SoFi Invest are seeing these headlines hit their notifications instantly. The reaction speed of the retail market has accelerated the velocity of these moves. You have thousands of traders who might use Robinhood fractional shares to take a small position, thinking this is just a momentum play, without realizing they're stepping into a complex merger situation. This creates a layer of volatility on top of the institutional buying. We see discussion boards lighting up, speculating on whether another suitor like Johnson & Johnson or Roche might step in with a counteroffer. That speculation is what keeps the stock trading at a premium, and it's why you see the price hovering right here at $101.42, rather than fading back down. It is crucial to understand the why behind this move. Why would a giant like Abbott want EXAS Sciences? The answer lies in the moat that EXAS has built around its flagship product, Cologuard. The expectation was that blood-based tests would eventually render Cologuard obsolete. The reality is that Cologuard has become a household name with immense brand loyalty and physician trust, something that is incredibly expensive and difficult to replicate. Abbott is not just buying a test, they are buying a sales force and a logistics network that can handle millions of stool samples with precision. For an investor using Schwab Intelligent Portfolios or looking at a long-term Fidelity wealth management plan, this validation of the business model is a vindication. It proves that the underlying asset had deep strategic value that the public markets were ignoring. The market was pricing Exact Sciences like a struggling biotech. Abbott is pricing it like a premier diagnostic infrastructure play. Let's pause on the technicals for a moment because the chart damage to the bears is severe. Before today, the stock was likely forming a base, trading in a choppy range that frustrated momentum traders. Today's candle has completely disconnected from the moving averages. When you see a stock trade this far above its 50-day and 200-day moving average, standard technical analysis often goes out the window, and you have to look at psychological levels. The $100 mark was a massive resistance point, a psychological barrier. Shattering it with this much force turns that resistance into support. If the deal talks were to somehow fall apart, which is always a risk in these scenarios, the fall would be precipitous. But right now the market is voting with its wallet that this deal is real. Traders on Interactive Brokers are likely looking at the implied volatility in the options market, which has probably skyrocketed. Calls are becoming expensive as everyone tries to leverage this upside, while puts are also bid up by nervous longs looking to hedge against a deal collapse. This brings us to the broader context of how people engage with the market today. Whether you are using Fidelity ETFs that track the healthcare sector, or you are hand-picking stocks in a Fidelity brokerage account, M&A activity is often the spark that ignites a sector rotation. When a leader like Exact Sciences gets taken out, investors immediately look for the next target. Money rotates. You might see capital flowing into other diagnostic names like Guardant Health or Natera as investors try to front-run the next acquisition. This is the ripple effect of a major deal. It's not just about EXAS anymore. It's about the valuation multiple of the entire diagnostics sector getting re-rated upward. If Abbott is willing to pay a premium, it implies that the whole sector was undervalued. This sends analysts at firms like Fidelity and Goldman Sachs back to their spreadsheets to update their price targets for competitors, creating a second wave of buying across the industry. For the self-directed investor, the person who believes in self-investing and takes pride in managing their own financial destiny, this is a teaching moment. It highlights the importance of patience and the danger of trying to time the market based on short-term noise. Those who sold Exact Sciences last week because of macroeconomic fears or rate sensitivity are missing out on a massive windfall today. This is why investment help often preaches staying invested through the volatility. The biggest gains in the stock market often come in overnight gaps that you can't catch if you're sitting in cash. If you were holding this in a SoFi active investing account, your portfolio value just jumped significantly, not because of anything you did today, but because of the decision you made months ago to hold a quality asset. Comment below how many shares of Exact Sciences you currently hold and at what price you bought them. Are you planning to sell into this news or hold out for a higher bid? Now, let's look at the business itself, because even if this deal is the headline, the fundamentals are what attracted the suitor. Exact Sciences is the leader in non-invasive colorectal cancer screening. Their Cologuard test addresses a massive unmet need, getting people screened who are otherwise terrified or unwilling to undergo a colonoscopy. The expectation was that this was a niche product. The reality is that colorectal cancer is rising in younger demographics, and the addressable market is expanding, not shrinking. They have also been aggressively expanding into multi-cancer early detection and therapy selection. This is the pipeline value. Abbott is not just paying for the revenue of today, they are paying for the data and the platform of tomorrow. The company has processed millions of tests, giving them a database of biological information that is virtually unmatched. In the era of AI and data-driven medicine, that database is a goldmine. However, we must discuss the risks. Even with the price at $101, deals fall through. Regulatory scrutiny is at all-time high. The FTC has been very aggressive in blocking healthcare mergers that they believe reduce competition. While this is largely a vertical integration, Abbott doesn't have a direct competitor to Cologuard. Regulators could still argue that it gives Abbott too much leverage over hospital systems. If you are trading this on interactive brokers trading platforms, you have to be aware of the break fee and the antitrust risk. If the news comes out that the FTC is suing to block the deal, this stock could drop 20% in seconds. That is the risk premium you are navigating right now. It is why the stock might trade slightly below the offer price to account for the time value of money and the risk of the deal failing. Furthermore, we have to consider the white knight scenario. Could another player step in? If you are utilizing Fidelity mutual funds that invest in biotech, fund managers are likely running the numbers on whether a company like Pfizer or AstraZeneca could afford to pay more. A bidding war is the